Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. Taking a look at a quick update from our 5 vol capture trades from Monday as a big drop in implied volatility, that reversion we expected. The price movement was actually detrimental, but the implied volatility move more than outweighed the adverse effect of the stock. So let's jump in and take a look at why implied volatility matters. So as we said, here was the original trade, UUUU, Energy Fuels, showing up on the scanner. You can see that huge lift in implied volatility, which was the impetus for the trade. You can see the jump here on a different basis from the mid kind of 40 area to 180. Calls certainly getting the IV lift more than puts. Also signaled a time to maybe jump in. You can see the October IV at 215 at the time. Certainly getting to extremes, implied volatility percentile, reaching the highest level of the past year at 95%, almost 350,000 option contracts traded. That's set up ideally for a couple of those different trades: covered call, put spread, iron condor, strangle right, and straddle that we recommended. We'll see how all those fared, right, once we saw implied volatility start to wane, which we did yesterday, right? We saw IV just collapse, right, from that peak where it was before, where we recommended getting in simply because of that jump in IV. You can also see here on that different metric, right, IV moving from basically 180 to under 140. Calls and puts now starting to lose that huge call skew, right, in a big way. Another sign that people are basically giving up on that insane lift in IV. You can see the October IV, which was over 200, now under 150. So that benefits all of our trades which capture IV. But we'll see in a second how the adverse price move in the stock, right, was a slight negative, but the IV effect more than outweighed it. So you can see IV percentile now at 70%. It was at 95 before. Volume about a third of what it was. It was over 360 when we recommended the 5 trades. A couple days later, it's only at 120. Here it is in a simple chart, right? I simply took the 60 and 30-day slightly out of the money calls and puts. This is the whole impetus behind our trade strategy here. Sell the rip, do it in a somewhat neutral fashion, or lean slightly bullishly with the call buying, and then buy the dip once it reverts. So let's see how we did on this trade, right? So here was our trade, right, going back to October 25th. The stock was at 21.37. This was a December 25 covered call trade. Buy the stock, sell that inflated call, because we saw the call IV jump off the charts here, right, in a big way, right? We saw the stock drop from our period that we did previously with the stock at 22.58. The stock dropped $1.21. The calls actually went up in that time frame. So set up ideally for that buy, right? Buy the stock, sell the calls at about 170 IV on the calls, giving us a buy right cost of 162. Fast forward to yesterday, we saw the stock actually drop $1.34. That should be a huge negative for the buy right, but the buy right actually increased 44 cents. Why? Because the December 25 call, which is well out of the money, dropped more than the stock drop. So our covered call trade, even though it's a definitely bullish trade and the stock dropped, the reversion effect more than outweighed it. So we were able to capture a gain on the buy right, because implied volatility, which we were able to sell at almost 170 on the call before, now at under 150. So the call price, like I said, dropped $1.78, outweighing the drop in the stock of $1.34. So certainly another reason to look at using implied volatility to structure trades. The October put spread, same sort of idea here. That put spread was priced at $1.12 with the stock at 21.37. Basically, coming into Monday. You can see the IV at the time over 220, right? The put spread out of the money by $1.37. Fast forward to yesterday's close. The stock dropped to 20.03, right? So the stock dropped $1.34, almost in the money on the put spread, yet the put spread, right, picked up 17 cents of value. Why? Because IV dropped almost 50 vol points. So another reason, again, to use IV to structure trades. Here you had a definite bullish trade and the stock dropping sharply, right? And that trade improving, right? Being profitable simply because the benefit of that IV reversion to 170 far outweighed the detrimental price move. The iron condor, same sort of idea here with the stock at 21.37. That iron condor, which was selling the 1917 put spread, the 26.28 call spread that expires this Friday, right? That iron condor priced at 95 cents. You can see both the puts and calls out of the money by a decent amount. The puts by over 2 points, the calls by over 4.5, and you're looking at over 200 on the put IV, almost 300 on the call IV. Fast forward to Friday, again the stock at 20.03. So that iron condor improved by 37 cents, a massive move, right? Capturing almost half the gain, even with the put spread side getting close to going in the money. The calls definitely out of the money. The reason why, again, this huge drop in IV. The calls dropping almost 70 IV points, the puts over 40. So again, sets up ideally using IV, that huge jump, right, in IV that we see here to structure the trades, to sell that rip, and then when it reverts back down to buy that dip. And then taking a look at the strangle trade, right, which didn't have the protective element of that iron condor, right? You can see with the stock at 21.37, the October 31st strangle, right, which is selling the 20 put and the 25 call, was going for $3.60. The IV, the average between the two, around 250. It would have been about 8 deltas net short simply because the IV, or the delta on the calls, was boosted up because of the upward drift we talked about in our original video talking about all 5 of these trades, right? Then fast forward to yesterday's close, you can see the stock did drop to 20.03. That strangle picked up over 2 points, so able to sell it over 3.5. Now buy it at $1.50 roughly, right? Very nice 2-day trade. You're now definitely delta long, and most of that is because the IV on the calls dropped to 211, where the prior day it was heading right at 280. So you saw a massive combined drop in the puts and calls of about 60 vol points on each. So this ended up being a super nice trade, even with the stock moving a little bit detrimentally, right? You ended up being net long with the stock dropping, but because IV just collapsed so hard, it had a very nice result on the trade. And then finally, in the November straddle, right, we went out to Nov. So the in-the-money straddle stock was at 21.37 at the time. The Nov 25 straddle, the puts were deep in the money, the calls out of the money. The delta about neutral. Why wasn't it bullish? Because, again, of that huge jump in implied volatility pushes the call deltas up somewhat artificially, especially on lower price stocks. So able to capture about a 200 IV on the trade for a pretty much delta neutral trade, able to sell that straddle at 10.35. Then on Tuesday's close, the stock did drop, right, $1.34, as we said. That straddle collapsed to $8.30, able to pick up just over $2 on that November 25 straddle, which was somewhat neutral, artificially so perhaps because of the delta effect, right? But now definitely getting long, right? So you should have had the trade go against us hard, right? Ended up being a very nice winner. Why? IV reverted 40 vol points, right? That huge, again, just rip and dip, right? Sell the pop, buy the drop, right? Just set up ideally for all these vol capture trades, whether it's leaning bullishly, like the covered call, what worked out beneficially, or the put spread, right? More neutrally, like the iron condor and the sell strangle and straddle that all worked out very well. So highlights how taking advantage of implied volatility to structure trades is a huge benefit, and especially when you do it in the proper way. So until next time, as always, here's the good trading. Take care.